Hello there, welcome to session 3 of the AS revision for business studies. If you're joining for the first time, my name's Alan Thomas and I'm a business studies teacher at Llanidloes High School. So let me just share my PowerPoint. Okay, so basically to the point we got last lesson was we're looking at this final section of Unit 1, which was looking at business revenue and costs. Okay, so the plan is today to try and get through as much of Unit 2 as humanly possible. Okay, so we'll sort of crack on relatively quickly with it. And with some of the stuff, because there's so much stuff to get through in Unit 2 and we're kind of running out of time a little bit, I'm going to gloss over a few of the bits. So this unit is we're basically looking at break-even charts and some of the terminology around that. Hopefully you've probably done this at GCSE and you kind of have quite a good understanding of what each one is really. Okay. So what are the following? What are we looking at? What are fixed costs? Fixed costs are costs that stay the same regardless of output. Okay, so things like rent. Okay, so regardless of whether you made 1,000 goods or 1,000,000 goods that month, okay, the rent was going to stay the same. So that's what fixed costs are. Variable costs are costs that vary with output. Okay, so the cost of your materials. Okay, so the more use of something you produce, okay, the more that you the more your variable costs are going to go up. Total cost, real straightforward, is your fixed cost plus your variable cost. Right, sales revenue, okay, is going to be the amount sold multiplied by the selling price. Okay, then your formula for profit and loss is your sales revenue minus your total costs. If your sales revenue is higher, you make a profit. Your total cost is higher, you make a loss. Now, in terms of how we go about plotting a break-even chart, relatively straightforward. Okay, so we don't bother plotting the variable cost. Let's see if I've got a better. So we'll have look at this one. Okay, so if you have a look, the red line there is your fixed costs. Okay, it remains consistent as you can see. If the output is 0, it's a 1,000. If it's at 800, it's 1,000. So it's remained the same. Your green line is your total cost line. Okay, so that's your fixed cost plus the variable cost. You can kind of see that there is no variable cost line on there. If it was, it would run parallel from 0 with the green line. Okay, and your purple line is your sales revenue. Okay, and you can see there it intersects at 500 units of output or £2,000. Okay, and any point after that, okay, is a profit. Any point before that is a loss, and at that particular exact point of 500 units, okay, it is the break-even point. Okay, now if, for example, 500 was our break-even point and we actually sold 700 goods, okay, we refer to that as a difference between 700 and 500 as the margin of safety. Okay, so basically what that means is we can still drop 700 units of sales and still be breaking even. Okay, if we drop down 201 units of sales, okay, we would start to make a loss. So the margin of safety is the gap basically you have between your break-even point and the amount that you actually sell. All right, now the break-even calculation, okay, relatively straightforward, is basically it's your fixed cost divided by your contribution. Okay, now what the contribution means is your selling price for 1 divided by take away the variable cost for 1. Okay, so let's say, for example, our selling price is £3 and our variable cost is selling price for 1 is £3 and our variable cost for 1 is £1. Okay, our contribution is £2. Okay, let's say our fixed costs are £200, okay, and our contribution is £2. Okay, it's £200 divided by £2 means that break-even point would be 100 units. Okay, right, now we're moving on to our second unit, business functions. Okay, so the content is divided up into 4 sections: marketing, finance, human resources, and operations management. Okay, these are basically 4 key functions or key departments within any particular business. Okay, so marketing is about finding out what your customers want, selling to customers, advertising to them, finding out where they're going to buy it, what's the rough price they want to spend. Finance, the producing of document and monitoring of financial accounts. Human resources is basically the hiring and firing of staff, making sure they're trained, making sure that people are in the right place. Operations management is basically your production unit. Okay, so looking at going about producing goods and what sort of motivates your employees to a certain extent. Okay, so it's quite a bit taken out here. Okay, particularly in the human resources unit. Okay, not much taken out elsewhere. Okay. So I'm going to start off with the marketing one. Now, I'm going to kind of make some sort of assumptions that you do know some of the basics that come along with this. Okay, and these are the marketing subsections of each one. Okay, first chapters of unit 2, section 1. Okay, is functional areas and marketing. Okay, I feel like we've touched upon functional areas. Okay, so these are the functional areas, ones we've talked about: marketing, human resources, finance, and operations, which is basically how we're dividing up our units in this one. Okay. All right. So what does marketing actually involve? Okay. So researching the market, so finding out what they want. Okay. So doing market research, analyzing that market research. Okay. Set some goals on what you want to achieve in your marketing, come up with a marketing strategy, okay, by using the marketing matrix, the 4 P's of marketing: price, product, place, and promotion. Okay. Right. So how do businesses go about deciding on how they're going to go about doing their marketing? All right. Are they going to be more market orientated? Are they going to be driven by what their market or what their customers want? Okay. Are they going to be product orientated, basically by looking at what they are strong at, okay, and sort of market and produce goods in that sense. Okay, so for example, if you work in a very dynamic market, okay, so like something like making mobile phones, okay, well, it's actually very difficult to maybe survey your market to find out what they want in their new phones, because I don't think I would be very sort of au fait or aware of what sort of these large businesses, these large tech companies can do with phones now. So when I get a new phone, I go, oh, look at these amazing features. I wouldn't even have thought of that. Okay, so some businesses are like that. Steve Jobs famously said, how do my customers know what they want if I haven't even told them yet? Okay, well, that's obviously someone who's not a market orientated sort of CEO or business. Asset and marketing is basically a mixture of the two. So, okay, so so looking at what the business is strong at, but also finding out what the market wants, but then sort of making decisions based on what they're strong at. Okay. So product. So what are we looking at when it comes to product? So we're looking at a business has a product portfolio. Okay, so it has a lot of different products that it sells. So we look at Cadbury's, look at Kellogg's. They sell a wide range of chocolate bars, sell a wide range of cereals. Okay, so that is what we call a product portfolio. Okay. Having a product portfolio helps the fact that you can spread risks. Okay, you can maybe take a loss on one product. Okay, you can benefit from economies of scale. Okay, all right. So these are all reasons why you have a product portfolio. Okay. A similar thing, product depth, breadth and depth. Okay, so sometimes you have sort of a range of products. Okay, so how wide is it? Okay, and then how deep it goes is the product depth. So you think about maybe look at a brand like Cadbury's. They have Cadbury's Dairy Milk, don't they? Okay, but then they have kind of subsections of that dairy milk, don't they? They have a depth of product there where they have Cadbury's Dairy Milk with caramel, Cadbury's Dairy Milk with dime bits, Cadbury's Dairy Milk with whatever. Okay, so that's an example of where there's a wide product breadth of a lot of different products, but then there is depth amongst each one. Okay, but that can also be looking at dairy milk. Okay, so not only got the different flavors, but you've also got the different sizes. Okay, so you've got the fact that it's in the small bar, the massive 1 kilogram bar, and all sizes in between as well. Okay, sorry, I'm rushing quite a bit. Right, you also need to have an understanding of what branding is. We all are aware of brands, okay, that we see a certain logo, certain slogan, okay, that triggers certain thoughts in our mind, okay, and it helps us differentiate them from competitors. And also it helps businesses really become more inelastic. So basically they can essentially charge more for their goods because of the sort of positive brand value that you have for certain businesses, okay. Okay, you also have to have an aware of what a unique selling point is. Okay, so unique selling point is something that makes essentially what makes you stand out from the crowd. Okay, so you know, is it a feature that makes you stand out from the crowd? Is it the fact that you've got excellent quality? Is it the excellent branding you have? Okay, what makes your product different and make it stand out from the crowd? I think they're relatively straightforward. Okay, and I think you probably have an understanding of what a unique selling point is, particularly if you've looked at any particular products or done any sort of looked at marketing. Okay. How you can go about differentiating, having a unique selling point. So like I said, how you promote, how you package, what it looks like, the quality of it, okay, the added features and so on, okay, and all this maybe creates some sort of customer loyalties, okay, and it has an influence over maybe the pricing strategies that you're going to use, which we'll look at a little bit later on. For this section, you also have to have an understanding of what the product life cycle is. Okay, so if you have a look at the axis, you've got sales along the left-hand side and you've got time along the bottom. Okay, now all products go through this where they're initially introduced. Okay, and what you see there is maybe a high spend on marketing and advertising, so people become more aware of the product. Okay, then you've got growth. Okay, so you start to see rapid growth there where you've got a lot more people becoming aware. I've become aware of your product and are now buying it. Okay, maybe switching from other competitors or whatever. Okay, or maybe the pricing strategy has changed and that's gained more customers. And then you've got this kind of leveling out period where, you know, as many people as possible is going to have known about your products and your sales sort of peter out and kind of remain relatively at its highest point for a decent amount of time. Now, some products will continue to exist in its maturity stage for a long time, particularly if it's not a very dynamic market. Okay, so if you look at something like cornflakes, that's been at the maturity stage for a very long time. Okay, probably about 90 years if I'm thinking, okay, if I'm thinking correctly. Okay, is that it's not a very dynamic market. Okay, they haven't really seen a particularly increase in sales or decrease in sales over that time, even though sort of a lot of competitors have joined the market. Okay, then you've got a period of saturation. Okay, where maybe the home market has been saturized. Okay, so you've got a lot of different a lot of new competitors in there. A lot of your competitors maybe copied what this particular product is. Okay, and then you start to see decline. Okay, now what you can do in the decline phase, okay, is you can allow your product to die. Okay, so if you look at, or you stop producing it. So if you have a look at, say, games consoles, right? Okay, so if you look at the different games consoles, we'll look at the PlayStation ones, right? So you've got PlayStation 1, okay, allowed to die. Okay, PlayStation 2 gets launched. Okay, then you've got PlayStation 3, 4, and 5 or whatever. Okay, so you've got it introduced, okay, growing rapidly and then maturing and then dying off. Okay, and essentially they get a new product. Now, if you look at the product life cycle of certain technological goods like games, consoles, and phones, they're probably going to have a product life cycle of 2 months, 2.5 years max. Okay, all right, that would be relatively dynamic. Okay, whereas you look at some markets that are less dynamic. Okay, they've got a product life cycle that is much longer. Okay, because the market doesn't really change much, like cereals, like bread. Okay, all right. One thing that's also worth noting, okay, is the fact that how you plot profits on here. Okay, now what you see during the introduction phase is you see sales are low, okay, but they're also spending a lot on advertising. So you see that the businesses are generally making a loss during this period. Okay, all right. So that's what, if you were plotting profit on the product life cycle, that's what also would look like. During period of decline there, okay, you might also employ some extension strategies. Okay, so extension strategies could include, okay, something like adding some new features, getting some new packaging, dropping the price, doing some sales promotion, okay, increasing your advertising on it. Any one of those, okay, in order to try and boost sales in of your product again and extend that product life cycle. Okay. Okay, you also have to have an understanding of this model as well. Okay, the Boston Matrix. Okay, so what you see here, all right, is Along one axis, okay, you've got market growth, okay, is it fast, is it slow? And then you've got market share, which is low and high, okay? So if you have a look at this now, okay, let's start on the top right-hand side with stars, okay? And what you've got there is you've got a product in your product portfolio that is seeing fast market growth and high market share, okay? Now, having stars is pretty good, pretty ideal. Okay, because it means that your product is very popular. Okay, but the only drawback of being in that stars phase is you're probably having to have a high spend, and profits are relatively squeezed because of the advertising cost to keep your product in people's awareness, okay, because it's a fast market growing, okay? So what you want is your stars to try and mature into cash cows, okay, where you're seeing the fact that the market growth is relatively slow, okay, but you're retaining a high market share, okay? You want your stars to turn into cash cows. So an example would be when the tablet market was booming, probably maybe mid to late 2000s, you had a lot of different tablets available on the market, okay? However, the iPad has become the unquestionable king of the tablets, okay? So now, in terms of market growth of tablets, the market growth is relatively slow, okay? Like everyone who's going to buy a tablet, you know, a lot of people already have those, so you don't have this massive increase in sales, okay? So now the iPad has beaten off a lot of competition now, okay, and is able to sort of maintain a high market share in a relatively slow market growth area, okay? Now, if you go back to the top left-hand side, you've got question marks, okay? Now, question marks, what you've got is you've got something a low market share, but fast market growth. So basically, in a developing market, the product that you have out there is not doing especially well, okay? All right. Now, what you can do is you can allow these products to die. You can kind of maybe realize that actually, this product isn't particularly working, okay, so I'm going to kill it off, okay, and maybe put my resources somewhere else. Or what it might be worth doing is maybe investing more in advertising, or maybe just sort of reassessing the marketing mix that you've got, or maybe it's product features, okay, to maybe sort of, you know, it's a fast market, you know, the market is growing, so you may as well maybe have a stab at it, okay? So there's two ways with question marks. That's why they're called question marks. Do you let it die, or do you invest a bit more in it? Now, dogs, okay, low market share in a slow growing market. Now, this is what you don't really want in your product portfolio, okay? However, a lot of people say, why not get rid of them? But to a certain extent, what it might do is keeping hold of your dogs. There might be some customers who are loyal to that particular brand, and might encourage them to buy another few products from your product portfolio. So it depends really, okay? You need to evaluate that, you know, on a sort of a product by product basis. So businesses use this, okay, to sort of decide where their products kind of are, all right, and what they're going to do in order to, how they're going to look at spending their money and marketing these particular products in their product portfolio, okay. So now we're moving on to price, okay, different pricing strategies, okay. So different types there, okay. These are some of the key terms, all right. So we will go through them in turn now, right. So what you've got here is you can divide them into two categories. One is market orientated, and one is cost-based strategies, okay. All right, and we'll go through those now. So what you've got here is market orientated pricing strategies, okay. So basically you decide upon the method of pricing based upon what the market is doing and what your competitors are doing, okay. So, you know, I'll pick out a few of these. So market skimming, okay, is where you start the price off high, okay, and it gradually drops off in price. So we're looking at things like phones, consoles, okay, things like that. Market penetration, okay, where you start off your prices low and then generally increase. Now that is to maybe raise awareness, maybe to get people to switch from one business to yours possibly, okay. All right. Destroyer pricing, okay, sometimes it's referred to as predatory pricing, where you maybe have maybe have a number of products in your portfolio, okay, and you want to sort of discourage a competitor from entering one of those markets. So what you do is you price your goods so low that you're probably making a loss on it, but it forces that business out of the marketplace. Okay, psychological pricing, so using things like £9.99 as opposed to £10. Okay, so make people feel like they're spending less and things like that. Okay, cost-based strategies. Okay, now essentially what you're doing here really is you're looking at the costs you created as opposed to maybe what your competitors are doing. So you look at what your total costs are and putting a percentage on top of it. Now, you need to have a look through these and decide, look at the advantages, disadvantages. But if you're looking at something like cost plus, for example, all right, what you would say is that if you're using cost plus methods, then if your costs are much higher than your competitors because maybe they're benefiting from things like economies of scale, then you're basically going to price yourself out of the market. Okay, so that's the drawback of using cost-based strategies as opposed to looking at what your markets are doing. Okay, moving on to promotion then. Okay, again, I'm sort of skimming through this marketing unit quite a bit because a lot of it, you know, has kind of been touched upon GCSEs and is relatively common sense based and can easily be sort of resolved through some top quality revision. Okay, so we need to know what difference between above the line and below the line strategies. Okay, and then looking at sort of what's good and what's bad about them. Okay, and why and how they go about choosing the right one. Okay. So what promotion is basically sort of advertising or sales promotion. Okay, so basically it's all about making people aware of your product and sort of encouraging them to buy it. Okay, so above the line is going to be some of the stuff that you see, the advertising. So TVs, magazines, newspapers, radio, internet, okay, social media, whatever. Okay, then you've got below the line. Okay, so it could be things like personal selling, doing sales promotions like buy one get one free, competitions, something like that, doing exhibitions, direct mailing, so we're talking like junk mail and the stuff that you get through on your email. Okay, I think people are a little bit wise to kind of below the line methods of promotion now. Okay, and definitely certain types of advertising becoming more and more prevalent and much more important now because of, you know, the rise of the internet and e-commerce and things like that. So how do you go about deciding upon it? All right, so what's your marketing budget like? Where is it in the product life cycle? What the target market accesses most. So like if you're selling a product that is primarily for over 65s, well, there's very little point getting some influencer from Love Island to do a sponsored ad on it. Okay, so it's just things like that. What are your competitors doing? So what you might get asked in your exam is you get a case study and they might ask you to advise upon a certain marketing strategy, promotional strategy for a particular business. Okay, well, you know, you need to think about also things like the size of the business. Okay, so if it's a small business, don't suggest TV advertising and so on. So, you know, it's a relatively straightforward kind of question. If you get it, you should be quite happy about getting that kind of question up there. Okay, where you're deciding upon a good promotional strategy, TV, radio, internet, social media. Are you going to do competitions, buy one get one frees, and stuff like that? Okay, you need to say what's good, what's bad about them, and come to a decision. Okay. Right then, we're moving on to the next factor of the marketing mix. Okay, we are rushing through the 4 Ps relatively well here. Okay, we're looking at place. Okay, now with place, okay, what we're looking at is how we're going to get our goods to our competitors, our customers. Okay, so if we look at this model here, we've got different channels of distribution. Okay, and at the top you've got the manufacturer. Okay, so the business who's produced the good, and the consumer. Okay, now basically who ends up with the goods. All right, now if we look at method 1, it's basically manufacturer selling to wholesaler. Okay, so the wholesaler is bought in bulk and then is selling to the consumer in relatively high volumes as well. So, you know, could be things as simple as, you know, if you're from a farming background, could be something like Winstay. Okay, or maybe if you're sort of down south a bit more, you might have seen a Costco around. Okay, so basically where you can buy in higher quantities. Okay, and businesses do that so they can sort of maybe shift stock a bit easier. Okay, Then you look at method 2. Now this might be a way that you access stuff from your local corner shop. Okay, so you might go to your local corner shop, okay, and get a can of Fanta and like a 50p bag of sweets or whatever. Okay, now that corner shop, okay, if it's a sort of independent one, basically what they've done is they've gone to a wholesaler, okay, bought loads and loads of cans of Fanta in bulk, okay, they've bought loads of penny sweets, okay, so when you go in there, basically what they've done is they've gone to a wholesaler, bought in bulk, okay, and then you are buying that from the retailer. So the manufacturer has made loads of goods, okay, sell it to wholesaler. A retailer, okay, so like a shop, has gone to buy from the wholesaler, and then the consumers are accessing it in that way. Now, some businesses operate as method 3, okay, where a manufacturer would sell to a retailer. Okay, so a good example would be retailer would be JD. So, and then different manufacturers, you're looking at like North Face, Nike, Adidas, whatever, you know, I don't know, whatever brands that are sold at JD. Okay, so there's a collection of brands within JD that are manufactured, okay, in one place, and you as a consumer go to JD to buy them, as opposed to doing method 4, which would be buying directly from the manufacturer. Okay, now buying directly from the manufacturer wasn't really a massive thing, unless you went to sort of maybe luxury sort of high-end shops, possibly. Okay. Because very few manufacturers used to maybe hold a presence upon the high street, for example. Okay, but now with e-commerce and be able to buy online, maybe if you're going to buy sort of a new pair of trainers, maybe you go directly to the Nike website, as opposed to buying from JD, for example. Okay, so that's one way, definitely. Okay, right. We talked about that. Right, internet marketing. We've talked about e-commerce for sure. Now, with the 4 different methods I've talked about, okay, most businesses don't just rely upon one. Okay, most businesses have multi-channel distribution. Okay, like they might sell to retailers, they might sell and also sell directly to customers. Okay, they might sell to wholesalers, but they might also sell directly to customers as well. So they're going to have different ways. So it's worth just having a look through those and looking at the advantages and disadvantages of using each different kind of method of distribution. Now, what you're going to have done doing your market research is to kind of find out maybe where your customers are most likely to shop for their goods. Okay, so they could be do your customers do a lot of online shopping? Well, might be worth investing more in your e-commerce site. Do they more likely access their goods from going to high street shops? Okay, well, you're better off placing your goods in the retailers then. Okay, so that's something that's going to come up from your market research. Okay, right then. Okay, and then it's pulling it all together. Okay, and creating a marketing strategy. Okay, so using the 4 Ps. Okay, price, product, place, promotion, and coming up with a marketing mix. Okay, so basically where you're going to sell your product, how much you're going to sell it for, what are going to be the product features, what kind of product portfolio you're going to have, how you're going to promote it, how you're going to advertise it. Okay, now how that's going to be applied, and it's going to differ between local, national, and global markets. Okay, are you marketing towards a niche or a mass market? Okay, these are terms that have come up. Okay, and we should probably understand the difference between local, national, and global by this point. Okay, and understand the difference between niche and mass as well. Okay, so moving on then swiftly. Okay, we are going to move on to the start of the finance section. Okay, so subsections: budgeting, source of finance, cash flow forecasting, profit and loss accounts, and ratio analysis. Now, some of that has been taken out and some of it has already been discussed about. Budgeting to begin with, which is relatively new, is new for what we're discussing so far. Okay, so what is a budget? Okay, and how they go about using budgets. These are the key terms that you need to have a good understanding of. Okay, so what they always do in this sort of introductory phase of each subsection of sort of marketing, finance, operations management, human resources, basically outline what a finance department do. Now, finance departments, they prepare documents, set budgets, okay, and make sure suppliers are paid. Okay, so budget is a financial plan. Okay, so looking at how much money you're going to collect in, okay, deciding upon roughly how much cost you're going to put out, okay, make a forecast of it, okay, and then divide it up into sort of subsections of how how much maybe each department has to spend. So how to go about setting a budget. This is the process. Establish aims and objectives of the business, set the main budgets for these particular departments of the business, production marketing in particular. Okay, break down the budget even further. So within marketing, divide it up into sort of subheadings of marketing. So this is for market research, this is for product development, whatever. Okay. And then once those budgets have been set, you're going to need to monitor them, see if it's going to be if it's favorable, adverse, okay, all right, and any variance, okay, needs to be examined and reacted to. So if you're not spending enough, why aren't you spending enough? If you spend too much, why has that happened? Okay, and then once you've gone through this cycle a few times, you develop good experience and knowledge of what should be budgeted for next year. Okay, zero budgets. Okay, now I've worked in both systems in school. I used to be in my old school, I was in charge of the business studies budget. Okay, and what I would make sure that I do, once they gave me a set amount of money, I made sure I spent every single penny of that budget, because for next year I could say, oh, well, I spent that money this year, I need the money next year. Okay, but really that meant that the school I was working for were probably wasting money, because I was making sure that I spent every single penny, as opposed to what you can do is you can do zero budgets, where basically no department has a budget to spend. Okay, so for every single item of expenditure, they have to justify why they're going to do this. So basically you're bidding for every single bit of spending that you're going to get. Okay, now that can probably cut spending. But the problem is it probably takes a lot more time of monitoring that kind of thing. Right, budgetary control. Okay, so we talked about this in terms of looking at any variances. Is it favorable? Okay, basically where revenue is higher or expenditure is less, or is it adverse where expenditure is higher and revenues are lower? Okay, so when you're looking at a budget, okay, you need to, when you're monitoring it, looking at the budgeted and the actual, okay, is the variance adverse or is it favorable? Okay, right. Next section is basically your source of finance. Now, you've already done source of finance in Unit 1, so I would say just review that from Unit 1. Okay, I would say there's no relatively little point of looking at it again. Okay, so you're looking at your external, your internal source of finance, short term versus long term. Okay, cash flows, Unit 2, Chapter 10. Okay. Now, cash flows has been taken out, okay, so you don't need to know what those are, okay? Right, the income statement, the profit and loss accounts, okay? Now, what I'm going to do is I'm going to make sure that we have an understanding of what it is, okay? Now, it's sometimes referred to as the income statement, okay, but it's very clear what it is when you say a profit and loss account. It shows how much profit and how much loss a business is making, okay? So I'm going to get up a slide that shows an outline of a simple and profit and loss account. All right, so what you've got at the top is you've got sales. Okay, now sales can be referred to as revenue, and sales can be referred to as revenue and can be also referred to as income or something like that. Okay, so in this example, okay, 96,500, okay, is the amount of sales that have come in. Okay. And then what you've got, all right, is the section below that, okay, which is your cost of sales. Now, your cost of sales is basically your cost involved in making the product. That's the key term involved in it, okay? For this example, what we've got is we've got the opening stock, okay? So on the 1st of January or whatever for this year example, okay, there's 3,900. Okay, all right, and then you've got your total purchases coming in. Your 28,600 is what they've bought during the year, and then by the end of the year, okay, they've got £4,700 left, okay, of the stock that they've bought. So basically, what you've got, opening stock at the 1st of January, purchase of what you've bought during the year. So you add those two together, and then you look at what you've got at the end, and then you take that away. All right. Now, you're probably wondering why there is sort of like a left-hand side and the right-hand side. Right-hand side, I would always say, is where you put your finished figures. Okay, your left-hand side is kind of where you put your sort of individual figures of things that are more broken down. Okay, so that 2,700 is basically 27,800 is your 3,900 plus your 28,600. Take away your closing stock. Okay, but essentially what you remember is closing cost of sales is your cost involved in making the product, your direct costs. Okay, now gross profit, you can see there. Okay, gross profit is your sales take away your cost of sales. All right, sales take away cost of sales. So 96,500 take away 27,800 leaves you the gross profit of 68,700. Now you're probably wondering, why the hell do we look at gross profit? Okay, well, gross profit helps us analyze sort of the direct cost involved in actually making the product. So how efficient is the business in using its resources? Okay, because there's a load of other extra gumph that go along with any business. Okay, but we want to break it down and see, you know, our inputs that are turned into our outputs. How efficient are we actually, sort of just in terms of actually making the product itself? Okay. Then we take away our expenses. Okay, so there are various other things that come into making it. Okay, wages, rent, rates, travel, electricity, whatever. Okay, and then we've got total expenses. Okay, now expenses can sometimes also be referred to as indirect costs, overheads, whatever. Okay, now that figure for 38,590 is basically all those figures added up together. Okay. And then you're left with this figure for net profit. Now, net profit is always what we think of what profit actually is. Okay, all right. So when I say the word profit, often what I actually mean is net profit. Okay. So for this example, if we see, all right, how we go out figuring out net profit. Okay, is we have got its gross profit take away expenses. Okay, gross profit take away expenses, or gross profit take away overheads, whatever it comes up in your exams. Okay, so a lot of people will struggle at this. Okay, but basically what it is a few key sums to remember. Okay, and I'll break it down a little bit for you here. Okay, so the first bit is the trading account. Okay, essentially what that is your sales take away your cost of sales equals gross profit. So sales take away cost of sales equals gross profit. Okay, and then the appropriation account. Okay, sorry, the net profit section of the business is basically your gross profit take away your expenses equals net profit. Okay, now there might be a subsection below it, but depending on the business that you have. Okay, now you all know that with net profit is basically a profit that you make within the business. Okay, and businesses are taxed on their net profit. Okay, so that might appear on a set of accounts that you look at. Okay, so you've got your tax, so net profit take away your taxes, your profit after tax, and then depending on whether it's if it's a PLC or a limited company, okay, you might have to pay dividends to shareholders. Okay, so that's how you go about doing that one. Okay then, all right. A lot of people worry about the sums involved when it comes to doing income statements of profit and loss accounts, but I wouldn't worry too much about them. It's more about thinking logically. Okay, right, the next one is ratio analysis, so how you go about analyzing different sets of accounts. Okay, now it's relatively straightforward, okay, when you are doing it at this level, at AS level. Okay, there are two different ways, ratios you need to look at. You're only looking at the profitability of the business. Okay, so you're looking at gross profit, okay, which is your gross profit divided by your sales times 100. Okay, and that gives yourself a gross profit margin. Okay, now what you want is your gross profit margin to be as high as possible, because basically that suggests that your business is efficient at turning its inputs into gross profit. Okay, because essentially what this whole formula is how good is this business at turning its sales into gross profit. The higher the gross profit, the less that they've spent on their cost of sales. Okay, they've been really efficient. Okay, and then you've got your net profit. Okay, which is your bottom line figure of what your profit actually is. Okay, so how good is your business at turning sales into net profit? Okay, again, you want this as high a percentage as possible because it means that they are being sort of the sales that they've got coming in, they're minimizing their expenses and their cost of sales, and they're maximizing their profit as much as possible. Okay, now what's also worth noting during this is if you're looking at your gross profit margin and your net profit margin, it's also a good idea to analyze the difference between the two. Okay, so let's say, for example, your gross profit margin is 85%, so that's a real high gross profit margin. Okay, but then your net profit margin is 10%. Okay, well, that gap suggests there's a real issue there, isn't it? That they're spending far too much on costs that aren't involved in making the product. So if you were analysing that as an accountant, you would go, what is going on here? Why are you having so much expenses? And there could be a reasonable reason for it. Okay, but that's what you're doing when you're analysing accounts. Essentially, is you are thinking, what is going on here? And I need to ask the question behind it. Okay, now in your exam, what you might have is you might have different competitor sets of accounts, or maybe different competitors accounts or different years. Okay, now you're unlikely to have to put a profit and loss account together. That would kind of probably be degree level. Okay, but what you might have to do is understand how it's put together, and you might have to fill in the gaps. And you'll probably also have to sort of undertake some calculations of your gross profit margin, net profit margin. So make sure you know your formulas, okay, and make sure you know what it means. Okay, right, absolutely fired through that finance unit. Okay, what we will do, okay, is because we're starting off a brand new section, and I'm a little bit OCD and I like to be a bit tidy, is that we'll stop here, which means that we've got two sections to do. Okay, so we've got human resources and operations management to do next week. Okay, I'll just check the chat to see if there are any particular questions today. Okay, no, nothing. All right, okay. So next week we will definitely get around to finishing everything. Okay, thanks for tuning in, guys. I'll see you next Monday for our final session. Cheers.